I'm the Regional Sales Director for the East Territory, partnering with BCA, and we're very excited about this relationship. All my contact information is on the screen, so if you don't have time to ask questions or can't think of any at the end of this webinar, or if you think of something a day later, please take my contact information down, both my email and my cell phone. Be happy to follow up with you and give you more information about our great company and our great product. We're really excited about the new enhancements that we just rolled out with on our IUL product a few weeks ago, and we're going to go into that in some great detail. But first and foremost, I know that there are some of those advisors that are on the line that might be unfamiliar with Allianz and our story, and really just how powerful we are in the index marketplace. Allianz has been #1 in index annuities 15 of the last 16 years, and for the past 4 years, we've had the best, third best index universal life insurance product for sales in the independent space. So we're very happy about that stat. Being the only carrier who's in the top 10 for both index annuities and index universal life. Now, from a carrier standpoint, we are proud to be part of Allianz SE, one of the largest insurance carriers globally. But what this strength allows us to do is we do a number of different things here at actually Allianz home office of North America in Minneapolis. One of the things that we do is we've created an in-house dynamic hedging platform. And what this allows us to do is purchase options for Allianz SE Global. So the largest insurance carrier, one of the largest insurance carriers in the world. We do all of the options purchasing in-house here at Allianz for our index universal life insurance business and our index annuity business. I don't know of another insurance carrier that can say that about those two lines of business. There's a few that might do that for their variable annuity side, but not for index annuity and index universal life. Now, for those of you who are familiar with index products, these options purchases are what allow the insurance carrier to help set those caps and those participation rates. So with this platform and having this in-house on our third floor here really can help us manage the impact of market downturns and really manage our assets in a way that can help guarantee the promises that we're making to our policyholders. So we can manage risk in real time by rebalancing our positions on a daily basis, multiple times a day. Helps us save costs, helps us save expenses, and definitely generates some advantages that we can pass on to contract owners and policyholders. We've got a number of different index allocations, our trigger method, our blended index, our BUDB index. These are some of the things that we've created here in-house for accumulation as crediting methods that you're not going to see from carrier to carrier, because it's something that they might not be able to do based on their scale. Being, again, the largest purchaser of options in the world, and that economy of scale really gives us an advantage there. So on the life insurance side, and what we're going to be talking about today, we've been laser focused on index universal life insurance for the past 4 years or so. We made a decision to take a look at our portfolio and realize what we're good at and then focus on that. Now, pretty good timing, taking a look at the industry. Index universal life insurance sales have seen pretty much on average 25% growth every single year for the past 5 years. This past year, still a great year for the industry, about 15%. And one of the highlights of what's going on in the industry is IUL just overtook term insurance for the amount of premium that we receive every single year. So that's a pretty good story to tell, where we've got 23% market share and term insurance has 21% market share. But we're laser focused in index universal life, and we do some of the best jobs in terms of accumulation and distribution in the industry. Now, don't want to get lost in the accumulation and distribution, even though this is how we're positioning many of our products, is for that benefit that we provide for our clients. But obviously, first and foremost, we sell life insurance for the death benefit. The income replacement for a surviving spouse, leaving a legacy to children, paying for college, paying down a mortgage, other debts, and also business succession planning, covering estate taxes, things like that. So anyone who knows, anyone who's delivered a death benefit to a client certainly knows the importance of life insurance and why we get up on a daily basis and do what we do. Our product also provides some great living advantages, and not only death benefit, but living advantages. The cash value accumulation potential on a tax-deferred basis, the ability to take tax-free loans from a policy, especially if you're working with clients for a concept of tax bracket management, helping them keep them to the lowest tax brackets, as well as the concept of diversification on the income side. If once they get to retirement, they have many different buckets that they can access to help keep them in those lower tax brackets and make sure that Uncle Sam doesn't get a majority of their retirement income. We also have some great chronic illness riders, as well as waiver of premium riders. Our waiver of premium rider, we can waive up to twice the target premium. And if you think about that conceptually, from target premium to maximum non-MEC premium, from about 1 to 3 of a ratio, this could actually waive up to 2/3 of the maximum amount of premium you could put into the policy. So great for small business owners, or a backdoor into maybe a doctor or a dentist or some of these other clients who might have maxed out their disability. But again, great chronic illness rider, great waiver of premium rider. And like I mentioned earlier, we just rolled out with some great new enhancements on May 24th. Now, this is actually an entire new product for us. On the LifePro Plus chassis, we made a decision to call it the LifePro Plus 7 to save some marketing expenses and to shorten up our timeline for rolling out with this product. But it's an entirely new reprice of the product. And some of the things that you'll see is overall pretty much a lower overall cost, upwards of, and then sometimes on average of 15% of total net cost that we've reduced. And we've also rolled out with a convertible term rider that's fully commissionable and a new interest rate bonus, and we'll go into all of these. So the first thing that I wanted to touch base on is a new convertible term rider. Now, this CVTR is perfect for clients who have bought into the concept of overfunded index universal life, permanent insurance, the ability to help supplement their income through retirement, but might not have a ton of disposable income right away. If you think about maybe a doctor, for example, who is just getting out of medical college, the doctor is maybe in residency, isn't making a ton of income, but you know that this client is going to be making a ton of money in the future, and also needs death benefit coverage. Who doesn't want to marry a doctor? These are highly sought after individuals. So you see these these people that are getting married early with not a lot of disposable income, not making a ton right now, but you have the ability to make more money in the future. And also, these are great clients to have throughout their careers and your career and your practice. So it's a good opportunity to get back in front of them on an annual basis, see what's changed in their life, and also have an ability to convert this term rider. But what this is going to allow you for is to have a reasonable cost for this rider, lock in their insurability, and again, have that ability to convert on an annual basis and get a commission there as well. So it's available at issue for an additional cost. You're able to convert a portion or over time all of the coverage to permanent insurance. If you see there on the bottom, from ages 18 through 50 at non-tobacco, you can have a 10 times the base a specified amount of index UL coverage for that term rider. So if you're a non-smoker and you're anywhere between 18 and 50, you can have a $100,000 base IUL policy and add on a $1 million convertible term rider. For tobacco ratings, it's going to be 5 times no matter what age that you go up to. And our policy does underwrite up to age 80. And also for ages 51 plus, you're going to see that move down to 5 times the base. We'll go into the schedule and what you can convert. So the conversions are available in policy years 2 through 10 based on this schedule. In year 2, you can convert 25%, year 3, 50% of the rider, year 4, 75%, and years 5 through 10, you can convert the full amount of the rider to index universal life insurance coverage. So after year 5, you can convert the full amount. You can wait till that entire time, or you can do this on an annual basis, doing annual reviews with the clients, seeing what's changed, and do that systematically, 25% each year. Our new interest bonus, really excited about this. We rolled out with this interest bonus to allow for a greater accumulation value. The way that this works is it's a multiplier bonus of 15%, and that number is guaranteed, and also a maximum bonus, so pretty much a cap credit of 1%. And that number is guaranteed as well. These will begin in year 11, so in years 1 through 10, you're not going to receive a bonus, but years 11 plus, you're going to get a 15% multiplier of whatever your index credited, whatever your client's index credited that year. And something to keep in mind is we're one of only few carriers that this interest bonus is applied to both the accumulation value as well as the loan value. So that's a big differentiator out there, because not a lot of carriers actually do that. So let's give an example of how this works hypothetically. If your client's invested into the S&P 500 annual point-to-point, and the S&P gets a 4% credit that year, okay? You multiply that 4% times the 0.15, so multiply it by 15%, and your interest bonus for that year is going to be 60 basis points, or 0.6%. So your end-of-year credit, that's going to be going to both, again, the loan value as well as the accumulation value or cash value, is going to be 4.6%. Now, anything over 6.6% is going to 6.63 or 6.64. But anything over that number is going to get the full 100 basis points, or the full 1% bonus. So for in the, I'm going backwards here from year 14 to year 13, but in year 13, on this example, because it's over the 6.6 and change in interest rate credit, you're going to get that full 1%. So the market credited 8% that year, or the index credited 8% that year to your client's policy, and the end-of-year credit in full will be 9%. So that's the total bonus and the total index credit for that year. And again, the other example in policy year 11 is you get a 11% credit to the policy that year. You add the 1%, and you will get a 12% credit. Now, also, if you get a 0 in any of these years, the 0 is going to be your interest rate bonus. Now, what you're going to be seeing here in the next few years, or even probably by the end of the year, is a lot of carriers that will be changing to this type of a bonus. These bonuses, if you have them, high, you're guaranteed of 75 or 100 basis points or so. If you have these guarantees starting in year 11, they're going to be extremely costly to the carrier. Now, this, we think, is a more responsible way to price these types of bonus, and what it allows us to do is do that that overall reprice of the product. So I think we've got a good give and take here, and I think it's a great value to have for your clients starting in year 11, and a great opportunity for more cash value accumulation. Here's some of the additional product changes. Still 0 to 17 juvenile, 18 to 80 for preferred plus and preferred non-tobacco. We've got 18 through 75 now for tobacco rating. So if you're a tobacco rater, we won't insure over 75. We did increase the premium charge from 5% to 6%, but what's great about that is you can take a look at our full costs in our product in the illustration, and because of the overall other lower costs that you'll see, these have pretty much stayed the same when the premium is being paid. Loan protection rider. This used to only be available to age 100. That's going to move out to age 120. And the additional term insurance is up to 2 times the base of the specified amount. Also, these new enhancements are currently available in 44 of the 50 states. And probably the majority of the states that you're working on, but there are a few that they have not yet been approved for. Long-term care rider, we need to refile in Connecticut, Florida, Maryland, and Minnesota. And we also removed our floors on our products. We had some opportunities for our crediting methods with a reduced cap and to have a floor of 2%. What we found is that very little of our policy holders chose that option. So that's something that we're going to be moving away with moving forward. All of these new sales tools and materials you can email me for. All of our marketing materials are consumer approved. So you've got the consumer brochure, even the agent guide. You wouldn't really want to use that for a client, but you know, that would be able to be used. Convertible term rider, sales idea. This is great for positioning to some of these younger clients. What a great opportunity it is to lock in that term insurance and to be able to convert that on an annual basis. And the Understanding FIUL brochure is a great piece for helping educate clients. And we've got a number of different marketing kits that we work with that educate clients. I think we do one of the best jobs in the industry of educating both advisors and clients. And we've got some great materials for the small business owner market to help fund college, retirement planning, as well as just tax-free retirement, how Index Universal Life works, and how you use Index Universal Life to position your clients to help diversify them for retirement. So we really do have some great sales materials, and both myself and Bill can help you get your hands on that. Now, one of the most exciting things that came with these new enhancements was that overall reprice of the product, and it allowed us to do some very cool things with the pricing of the product and how we look from a competitive standpoint on illustrations. Now, we wanted to see right now, with everything that I'm sure that most people, you're familiar with, if you're familiar with the DOL, you're familiar with AG 49 because you're in touch and in tune with the industry. But AG 49 is pretty much a regulation or actuarial guideline that came through to allow for the maximum amount of an illustrated rate from carrier to carrier. And this is based on each carrier's S&P 500 annual point-to-point index. And they chose this because this is the index and the crediting method that every single carrier has. So what you'll see here is each carrier, most of these are on the top 10. I don't know if Hancock is, but most of them are in the top 10. And what you'll see is the maximum illustrated rate that they're able to offer. And these are correlated, for the most part, besides Penn Mutual, to that S&P cap. Now, what you'll see in the difference between Penn Mutual and the other carriers, that they're able to illustrate at 7.2%. That's because their product has a floor on it. And what Penn Mutual is saying what AG 49 allows for is that if you were to put a floor on the product, they're able to say, what would our S&P cap be if we remove that floor? So a little bit of an ability to play games with that there, but I'm perfectly okay with that. So you'll see their maximum illustrated rate is 7.2%. And right now, Allianz and our LifePro Plus maximum illustrated rate is 7.09%. You'll see also the carriers of that accumulation bonus, whether theirs is or is not guaranteed, on the right-hand column as well. And again, our guaranteed bonus, the multiplier of 15% is guaranteed, and the 100 basis points of cap is guaranteed as well. Here's a number of different crediting methods that each carrier offers. Again, we're one of the industry innovators in some of the new and creative indexes that we have. Blended index strategy, 16% annual point-to-point for a cap. The trigger method, which a lot of agents, a lot of clients love, is really unique for the industry. This is an S&P 500 annual point-to-point, and it has one of two options for a crediting method. If the S&P is up or zero, or up or the same, you will get an 8% credit to the policy. If the policy, if the index, the S&P goes down, you'll get a 0. So if the S&P is up 3%, well, the trigger method allows you to get 8% that year. If it's 5%, 6%, you get 8% that year. So really unique, really cool crediting method. And then we have a volatility managed index called the Barclays U.S. Dynamic Balanced Index, or BUDB for short. We came out with that. We have a non-compete for the use of the Barclays in the S&P up to year 2020. I think it's August of 2020. But you're going to start to see the volatility managed index being more and more copied throughout the industry with a different bond fund or a different index fund. But I just think this goes to show how important it is to have different crediting methods than just the S&P 500 annual point-to-point. From a competitive standpoint, loans, I think Allianz, and I'll say this maybe with a little bit of bias, but I would be happy to debate most of the other wholesalers in the industry in terms of the loan options that we provide, being the best in the industry. We have a participating loan that is guaranteed at 5%. Now, the other carriers would have either indexed or variable loans. Variable loans can move on a monthly basis, and that's mainly tied to the Moody's. But ours is guaranteed to be fixed 5% for the life of the contract. Second question is it guaranteed? Yes. It'll never be anything other than the 5% there. The ability to switch between loan types, which is extremely important. And there's some I guess, little numbers there that say yes to void. There's some carriers that will only allow you to do it once, and then you're stuck with that. Now, there's others that will allow you to do it, but you have to repay the loan before you're able to switch. So you have the ability to switch loan types back and forth every single year with us to both, let's say it's starting in year 11, you could have a wash loan and switch that back over to a participating loan and back and forth. Now, we are, I believe still, we're the only carrier that would allow you to have both a fixed loan or wash loan out there at the same time as a participating loan. So you can have both of these loans out there at the same time. And also, I believe, if you see by the list, we've got the ability to allocate loaned and unloaned values differently. So what do I mean by that? If a client is in the same year paying a premium, deferring the cash value, but then maybe taking a participating loan, you can specify, your clients can specify the new premium that's coming in. You can say, well, I want that as the S&P 500 annual point-to-point. For the cash value, You can say, I want that allocated towards the blended index, annual point-to-point. And for the loan value, you can say, I want that to the trigger method. So you have the ability to allocate both, again, the loan value and unloan values differently. And you see no one else on that list, or that I know of in the industry, has the ability to do that. Also from a loan standpoint, and quite honestly, we took this from Voya because we're the only ones that I know. Maybe one other is developing this right now. We've built out a concierge loan team. So we thought it was a great idea if these products are being positioned, or sold with some intent to be taking participating loans or any type of distribution in the future. It's going to be helpful and maybe imperative to have that staff here at Allianz educating clients on what features and what benefits and what loan options are available to them. So we think it's very, very important. And so again, I think we have the best loan options in the industry with our product. Now let's take a look at the income comparison. Here is a 45-year-old male with a preferred plus non-tobacco rating. He's going to put in a $25,000 premium payment every year for 20 years. And then we're going to be using the increasing death benefit and switching to a level death benefit in year 21 after we stop funding the policy. In year 21, we are showing participating loans in year 21 through 40. Now what you're going to see here is every carrier's maximum illustrated rate on their illustrations based on that AG 49 guideline before. And as you can see, we come out on top for income, even though we might not have the highest interest rate. So you can see there some other carriers have higher interest rates. With the Mega Builder, we have the same, and they have this product, the 30-year payout, which overall reduces a lot of charges and allows them to illustrate higher. But this is including that benefit to the product. So this is at maximum illustrated rates. And here's at a 6% rate. As you can see, same client, same $25,000 for 20 years, same design for income, and we're coming out on top with income. Now I was speaking with Bill beforehand on the case, and we've done a lot of research on that. And Bill, is very in touch, as I'm sure you all know, with his agents and the way that they're designing policies and making sure that they take a look at multiple different carriers that are out there. He's saying that we're winning in almost, in most demographics. Forget the percentage that we gave out there, but there's a few, years. I think maybe like 52 or 52-year-old male or something like that that we might, lose out on. But in most demographics right now, comparing us like with other carriers at either a current interest rate, below 7% or at maximum illustrated rates, we're looking pretty good on paper. So I wanted to just at least touch base on that to see how powerful the new enhancements and the new repricing of the product is. That is what I have for the new enhancements. Again, my contact information or anything in general. If I'm not able to get the answer right away, I'll at least make sure that in the next couple hours or so, I respond back to you in an email or a phone call to clear that out. But would be very happy, again, to open it up for any questions that we have right now.
see our costs incrementally increase as we're making contributions for the first 5 years of the policy. Then we're not putting any more money in. We're done. But every year, year 5 plus, until death, the carrying cost is approximately $85,000. The other side, they paid out of pocket forever until they die. Their true cost, what they have to create to pay taxes to be left with the premium to put in the policy, their true cost is $470,000. That means even when we get up to our full load and our carrying cost, we're saving them the better part of $390,000 a year. Every 10 years, then, we're saving them the better part of $4 million in out-of-pocket costs. Think about that. Think about the power associated with that. Every 10 years, they save another 20 years, $8 million in costs. Finding a successful business owner in America that this doesn't make sense for. For example, let's revisit it. When we look at estate planning, enormous market. How big it used to be? It used to be a bigger market prior to Bush. There was an